can start today. From the News Channel 5 Network, this is the Retirement Report.
Good morning. Welcome to the Retirement Report. I'm Hank Parrott, your host. You know, last week we got in talking about Medicare. And since then, of course, we've also tapped a little bit on the markets, and this is one of those areas in particular I want to just touch on briefly. When you're seeing the markets in the turmoil that we're having, the volatility that is, and seemingly day to day, you're not sure what to think. But this is the thing: you'll have a day that it pops up. Like yesterday as an example, or day before yesterday, where the market has a really good day, and then yesterday a really bad day, and then today, who knows what it's going to do. It's a Friday. Usually on a Friday, this is one where a lot of times investors don't want to be sitting in positions maybe over the weekend, in particular if they're concerned about volatility or losses. So we could end up with a down day today as well. We'll see how it goes. Bottom line is what we're seeing, though, year to date, through now, this will be the end of the third quarter, and as we're looking at the first two quarters through June, we saw the market really take a hit. Then in July, it popped back up. Then in August, it's down, and in September, it's down. And you get these brief little increases. We've had, in fact, 3 negative 10% drops through legs, if you will. So where the market dropped 10% or more, went back up, hit some kind of high, dropped down from that another 10% or more, up again, and then the third time down. And this third time, typically, again, these are, statistically, if you will, and most of the time it works this way, so there's always going to be exceptions or times it doesn't. But usually when you hit that third leg, the market continues down, finds a bottom, and then we'll, get back into positive territory again over time. Now, how long that's going to take, that's, of course, always the million-dollar question, and that's a tough one because one of the things that we're looking at, there's a lot of different catalysts. Earnings season, where, earnings coming out for the companies, what that's going to look like, projections for the holidays with regard to consumer spending. So far, that's been a positive number, but again, a lot of things can change that. Of course, the Fed will be raising rates again. Then you have the election coming up, and it's only like 5 or 6 weeks away, crazy as that is. All of these are catalysts that could drive markets in either direction. So this is a time to be, again, looking at where you're at, your positioning. Okay, it's not a time to bail. As long as you're invested correctly in the market, and by that I mean you've got a well-diversified portfolio, you understand the principles of asset allocation, and you're not too, overly, for instance, you don't have everything in tech, right? That would be dangerous. You want to have more diversification than that. Asset allocations, or whether you're, so whether you're talking small companies, large companies, and a very diverse group of companies, so thousands, in fact, of companies, that's when you're going to, that's going to be a lot safer for you. And we know they're not all going to go out of business. Another thing you look at is over the sectors of the market. So if you're talking about, as I just was, tech, telecommunications, healthcare, banking, finance, all of these different sectors, you also want to have that spread. So between the asset classes themselves, the different size companies, as well as the different sectors of the economy, you want to have a well-diversified portfolio. If you have that, right, having that caveat in there, right, then yes, you want to stay disciplined at this point. We know that the markets, I think statistically it's 1 in 4 years are negative years, and about once every 10 years rather, we're going to have a bear market. Let's see if I have that, in fact, handy, just to cover. Yeah, over the last 70 years, corrections of at least 10%, negative 10, happen about once a year. All right, and we've seen that 3 times this year, and then a negative 20% or more about every 6 years. And then historically, about 1 in 4 years are negative. Again, about once every 10 years, we're going to have a bear market. And keep in mind, with the bear market, you can see drops of anything from mid-30s to mid-50s typically, and that's the way the case has been over the last 20 years, the last 3 bear markets that we've had. What we're going to see this time, we're down about a negative 25% year to date. Whether we get good news that it's going to help turn the market the other direction, and of course inflation and the inflation numbers coming out, and seeing whether we're making any inroads towards reducing inflation or whether it's increasing, is also going to play into all of this. So, bottom line, stay disciplined. By the way, and this is another, it's a good time to reevaluate your portfolio and reevaluate your overall plan. So making sure that you have the income that you need, for instance, if you're pulling money out of your portfolio when the market is going down, right, what's happening? You're having to sell, those shares are getting cheaper. That means you have to sell more and more shares just to get the same amount of money. And then, of course, you've got the other part of that with inflation, with the cost of things going up, you're needing more and more money just to cover the same lifestyle that you have. So you're kind of in a double squeeze here. Now, these are not long-term problems, but in the short term, they can be addressed. You might, for instance, if you're pulling money out of your market portfolio, maybe you've got, if you've got some money sitting in the bank, if you've got maybe some annuities or, other safe assets, maybe you switch over and take some of that income from there instead, and instead of selling those shares cheaper and cheaper and reducing the amount of shares you have. So that's something to consider as well. If you need some help with that, if you'd like to get, in fact, a complete comprehensive financial plan done for you that's going to be specific to your situation, just call my office. That number is 615-376-5325. And when you call the office, we're going to get your information. We'll send you out a checklist of things to bring to your appointment with me, and we'll cover a number of topics for you. In fact, we're going to be talking about Medicare today. We're going to finish up where we were last week. In addition to Medicare questions, we get into Social Security and, when's the best time to take Social Security for a couple. There are different strategies that can be employed. If you're already taking Social Security, how to minimize taxes on your Social Security benefits, how Medicare and healthcare costs factor into that. That's all just part of that comprehensive financial plan. Of course, we help you with an investment analysis. We look as far as safe money options, different ways to manage risk. So we're going to look at your income, your expenses, your assets, any liabilities, and factor in for inflation, for taxes, rates of return on your money, all of that. And with that, I can show you your financial future based on what you're currently doing, and then share with you strategies I've developed over the last 30 plus years working with clients to help you improve that picture, to make sure you're able to attain and maintain your standard of living and quality of life no matter how long you live, never have to worry about running out of money. So again, let's get that number on the screen if we could. It's 615-376-5325. If you'd like to get that comprehensive financial plan, just call my office. Again, when you call in, we'll get your information. There we go. And with that information, we're going to send you out a checklist. So basically just an email and an address or whichever way you'd like to receive it. And that checklist, like I said, it'll go over all the different things we were just talking about. And including your lifestyle expenses, we'll send you a lifestyle expense worksheet to help you determine that. That's a big help for. You'll find that to be very eye-opening, I think, and also helpful. And then also when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. In those first few chapters, I talk about the first 2 chapters about the planning process. Chapter 3 is IRA Mastery. This is about how to minimize taxes, in particular when you start taking money out of your retirement accounts. Chapter 4 is on safe money investments. So we get into all kinds of things from banking and bonds and fixed index annuities and fixed annuities. Chapter 5, How the Smart Money Invests, talks about modern portfolio theory and helps you understand, if you don't already have a good grasp about the terminology in terms of being diversified, about asset allocation, about how to structure a portfolio, that may be helpful for you there. Chapter 6 is on long-term care, and that's going to kind of tie into what we're going to be talking about today with Medicare. We're going to, how Medicare addresses long-term care and how you need to factor that maybe into your planning. And then Chapter 7 is on estate planning, and this is where we get into the 5 essential documents that make up the foundation of a good estate plan. So all of that in the book, that's yours, and it's also part of the planning that we would do with you. All right, so joining me today, I have Warren Cranford, and Warren is a benefit specialist when it comes to Medicare. Warren works with clients, and this is one of the things, by the way, the companies that when you are eligible for Medicare, when you get onto Medicare, and for those that already have Medicare, we're going to talk about the different parts of Medicare, different costs that you're going to entail, and that you're going to have, in fact, even with that. So this is one of those areas, first and foremost, when you are eligible for Medicare at age 65, when you can get Medicare, doesn't mean that your health care costs all of a sudden are taken care of completely. As we're going to get into, you're going to have potential lots of out-of-pocket costs, premiums, deductibles, co-pays, things that aren't covered that fall under that category as far as Medicare. And we'll talk about things like dental and vision and a number of things related as far as your health care costs go, so that you can then plan in particular open enrollment period coming up. So for those of you that have Medicare, it's a good time to maybe reassess, do you have the best plan for you, and might we and help you as far as comparing. And where I was going with this, of course, is that Warren, you don't have to pay him. Okay, these companies, right, that provide these products for you, they'll pay him, doesn't cost you anything. So you can get some good advice, and we're going to cover a lot of things with that this morning. But first, we're going to take a break. Join us here. We'll be right back on the Retirement Report.